All right, let's jump right into this explainer. We're unpacking a massive, literally tectonic shift happening in the markets right now. We are talking about the incredible high-stakes friction between a suddenly very defensive macro market and crypto's impending harsh regulatory reality. If you've been watching the charts lately, you know things are getting incredibly tense. So we're going to break down exactly why traditional money is moving the way it is and what that actually means for the future of digital assets.
Okay, so here's the absolute crux of it all. Capital choosing shelter over spectacle. I mean, that phrase just perfectly hits the nail on the head, doesn't it? It brilliantly sets the mood for our entire discussion today. We're seeing a market where investors are suddenly slamming the brakes and demanding hard proof of earnings. They're stepping away from those flashy high-growth tech narratives, the spectacle, and running straight towards safety and resilience. They want shelter.
So, to make sense of the whole shebang, here's our roadmap for today. We'll hit the great defensive pivot, look at crypto's fragile trust layer, dive into the MiCA regulation deadline, check out the exchange survival list, and finally, wrap up with building for real trust. Let's get to it. Starting us off with part one, the great defensive pivot.
Right now, we are seeing this wild, stark split in the markets. Traditional money is basically running away from the AI cost shock. On one side, you've got the spectacle. Think massive, high-growth tech giants like Apple and Microsoft. Sure, they retain their long-term relevance, obviously, but right now, they are facing intense margin pressure from surging memory and chip costs driven by the whole AI infrastructure build-out. Capital is demanding actual proof that all this spending is going to translate into earnings. Then, on the other side, we have the shelter. We're talking defensives and utilities, companies like Johnson & Johnson, American Electric Power, Xcel Energy. Capital is aggressively moving here because these heavily regulated, cash flow visible companies act as rock-solid stabilizers. They are overriding near-term risks.
And the clock is absolutely ticking. Just look at these critical dates coming up. You've got General Mills on July 1st, PepsiCo on the 9th, and Johnson & Johnson dropping Q2 earnings on the 15th. These aren't just random dates. They are critical catalysts that are going to enforce strictly disciplined capital allocation across the board. The market is watching these traditional defensive anchors super closely to validate this massive rotation. But wait, why this sudden flight to safety in the first place? Well, it boils down to one number, 3.4%. That was the core PCE inflation rate for May. It's stubborn, it's sticky, and it is keeping interest rate expectations incredibly tense right now. When inflation just hangs around like that, growth-oriented sectors take a serious hit. And that is exactly what's driving this broad defensive rotation we're seeing.
You can literally see this capital rotation playing out in a real time. Defensive healthcare fortresses, like J&J, are closing strong because investors just want a safe balance sheet. And utilities? They're acting like a massive anchor in a stormy sea. Companies like American Electric Power are hitting 52-week highs in a really noisy market. It's a crystal clear picture of where the smart money is currently finding its calm.
Moving right along to part two, crypto's fragile trust layer.
So if the big traditional markets are actively running for cover, where on earth does that leave the highly speculative emerging Web3 space? Well, it gets ugly. This captures the visceral reality of a market in a truly foul mood. We're talking about a brutal leverage flush right around the 60K zone for Bitcoin. When macro capital gets defensive, speculative assets get hammered. This puts immense, crushing pressure on overleveraged positions and rigorously tests the absolute foundation of crypto's infrastructure. As that infrastructure gets stress-tested, we really need to look at these massive buzzwords like tokenization. Is it real innovation, or is it literally just new packaging? We've got to ask the tough questions here. If you hold a tokenized asset, what do you actually own? Who actually owes you? And crucially, where do you enforce your legal rights? If those answers blur the lines between real shareholder rights and mere synthetic exposure, then I'm sorry. It's not innovation yet, it's just packaging.
Which brings up some massive, heavy critiques of crypto's trust layer. First off, stablecoin plumbing? It only works if you actually know who's in control and what jurisdiction you're dealing with. Second, we've seen with polymarket exploits that even with fancy decentralized on-chain settlement, the front end can still be totally vulnerable. Third, when a treasury strategy's MNAV literally drops below the actual worth of its underlying assets, slipping below that one-to-one peg, it absolutely shatters conviction narratives. It proves financial engineering can't survive on hype alone. The big takeaway? Being on-chain does not automatically earn trust. Trust is earned when the boring parts, like security and governance, become just as bulletproof as the exciting parts. All right, on to Section 3, the MiCA regulation deadline. This is the ultimate stress test, guys. We are looking at a regulatory battlefront that's forcing the entire crypto industry to basically grow up overnight or face total exclusion. July 1st, 2026. That is the day a massive, heavy iron gate slams shut on unauthorized crypto operators in Europe. After that date, providers without a license literally have to cease operations. Boom. Done. It's an absolute shift from the Wild West to a tightly controlled, regulated environment. But regulation is totally a double-edged sword here. On one hand, MiCA forces platforms to segregate assets and creates this much-needed institutional trust. We love that. But on the flip side, it threatens to seriously fragment access and liquidity across the ecosystem. We're already seeing access pressure on major platforms. When non-compliant platforms get restricted, users might suddenly find themselves totally cut off from the global liquidity pools they're used to trading in. Which leads us right into Section 4, the Exchange Survival List. Let's break down exactly what this regulatory transition means for the platforms holding your hard-earned assets. This landscape shows who is offering shelter and who is presenting some major operational risks. Over in the green zone, you've got authorized players like Bitpanda and Kraken. They're compliant, they're ready to go. The yellow zone, platforms like OKX and KuCoin. They've got some serious operational hurdles to jump over. But man, the red zone is where things get scary. Giants like Binance and BitGet represent high uncertainty and severe risk of service ending if licensing fails. If your assets are sitting in the red zone, you are taking on massive institutional risk. So how do we navigate this? Here is a quick 3-step tactical action plan you should honestly be doing right now. Step 1. Verify your entity. Go check your user agreements against the authorized registry. Step 2. Reduce your exchange exposure. Get your long-term bags off the exchanges and into cold storage hardware wallets. Keep only your active trading capital on regulated platforms. And Step 3. Monitor the market signals, especially the quantum clock and treasury flows. Protecting your capital from a potential exchange lockout needs to be your absolute top priority. Finally, wrapping up with Section 5, building for real trust. With traditional money demanding safety and regulators slamming the gate shut, who is actually stepping up to the plate? Well, take the KINGFINITY or KFX ecosystem, launching October 7th, 2026 on Solana. This is a direct attempt to answer all those harsh market critiques we just talked about. They're aiming to build a premium brand centered entirely on what traditional markets are demanding: absolute treasury visibility, on-chain accountability, community participation, and long-term ecosystem health. And the numbers here are pretty fascinating. The absolute standout in their tokenomics is this massive 35% chump allocated directly to a treasury framework. Instead of just running on pure hype, this shows a structural, built-in commitment to actual capital honesty. When you match that with 30% for public distribution and only 10% for the team and founders, you start to see an infrastructure that's genuinely designed to survive the exact stress test we've been breaking down today. Transparency comes first. So if there's one crucial takeaway today, it's what true crypto maturity actually looks like. It means stepping up and meeting the exact same standards of reliability, rights, redemption, security, and governance that crypto originally set out to replace. Ultimately, if you want to replace traditional finance, you can't just be faster. You have to beat it at its own game of stability and accountability, especially when the market is under immense stress. And that brings us to our final thought. I really want to leave you with this provocative question to chew on. Is crypto truly ready to be trusted when the broader market is not in a good mood? Think about that the next time you see capital rotating out of the spectacle and running straight into the safety of shelter. Thanks for hanging out with me for this explainer, and remember, always keep your eyes on the fundamentals.